The first part of the finance session this afternoon is called the Basic Guide to the LIBOR Transition. And I'd first of all like to introduce Mrs. Dora Mace-Kokota, who's a partner of Stephenson Harwood, based in London. And Dora is going to give us just a short presentation about the transition from LIBOR. Dora, please. There we are, perfect.
Thank you. Thanks, Kevin. Thank you to you and to Marine Money for another great opportunity this year. And although I must admit I would much prefer the Dorchester, it's great to be here and to be having this discussion. I will be joined by Barrand and Christos Begleris later on, and we can introduce them properly before we start our discussion. But I think I wanted to take a few moments to mention LIBOR, to see where we are in terms of LIBOR, what's happening in terms of its potential substitution, in terms of different currencies as well. I think it's one topic that, despite the fact that it has been in the very forefront of the finance markets, as well as the relevant regulation and the legal sort of spectrum that accompanies all of that, it is one that I don't think has received perhaps enough publicity, particularly in the context of ship finance. So today's idea to talk about it and to bring it a bit more into the public eye was to discuss, of course, where we are in terms of it, but also to try and make the discussion about it a bit more interactive, bring it more into the public, and create a further forum where we can all introduce different ideas and think about how we can take it forward. It has been referred as, if not the world's most important number, as one of the most important numbers, and it has been almost 4 years actually since, at least in the UK, the Financial Conduct Authority announced that it was going to be discontinued. It is coming, the discontinuation is coming, so I think it's pertinent to take the time to see where we are and exchange reasonable and good ideas as to how to take all of this forward. So to start with a recap, thanks for the slide, Kevin. In terms of the English market, where we are is that the very long title, Working Group on Sterling Risk-Free Reference Rates Committee, the SWG, and the Alternative Reference Rates Committee in the US have finalized and published their recommendations. The publications suggest plug-in provisions for the US law standard loan documentation, and in the LMA, in the English law documentation market, there are suggested forms of switch provisions for English law and under English law that have been put forward, but are not officially recommended yet. At the same time, in terms of swaps, where we are is that the ISDA has provided fallback supplements and protocols published in October 2020. And although we may as well touch on our discussion later on derivatives and so on, this is a topic that merits a whole other new discussion in terms of what happens in the parallel universe of derivatives once the products and the way forward has been settled in the loan documentation as such. Next slide, Kevin, please. So where are we now in terms of sterling loans? I think the position is very clear, and it is clear because there is a move towards transition to SONIA. There are clear deadlines. There is a discontinuation of sterling LIBOR that is coming up on the 31st of December 2021. All new loans are supposed to incorporate rate switch provisions after the 31st of March 2021, and all new loans are to reference SONIA from day one of each loan after the 1st of January 2022. So I think, unlike Brexit and so many other things in English everyday life at the moment, there is a clear path in terms of SONIA and sterling LIBOR discontinuation. There are clear recommendations for the key terms. So there's daily non-cumulative compounded SONIA in arrears. There is also LMA drafting that reflects and accompanies that. And we know that some lenders and other financial institutions have already started referencing SONIA, not necessarily in shipping, but definitely in other sectors. So all of that is very clear and fine. Next slide, Kevin, please. Although some have a different position and different outcome, again, the position in terms of euro loans is very clear. There is no change for now in terms of the euro loans, as the discontinuation of Euribor has been postponed. The methodology for calculating Euribor has been reformed over the course of the last couple of years, bringing it in line with EU regulation. And in theory, it has made the Euribor suitable for continuing use in the market. So far, the market seems to have accepted that, and the loan documentation seems to proceed on that basis. There are discussions about the euro short-term rate that I've put up there in the slides, potentially replacing Euribor, but the specific terms are still uncertain. And although the ECB, the European Central Bank, has launched the consultation process, this is still ongoing, and the results of that remain open. So on that front, we are very much waiting to see what happens, but it is very much the case that in the euro space, the euro loans are very likely to continue referencing Euribor for the coming few years. Next slide, Kevin. What's happening with US dollars? Well, the position with US dollars is very, very different, and we've got a lot of uncertainty in this sphere. Although the ARRC, the Alternative Reference Rates Committee, has put recommendations forward, and these are very clear, there are recommendations for more than one options. So, for example, there is a recommendation for simple or compounded SOFR. And this means that this leads to most lenders being uncertain and have not decided about which option will be the best for them. Although what we are seeing in the market is that they are tending to start to explore, or indeed in certain cases implement, the compounded option, which seems to work better with internal banking systems as well. Obviously, the drafting and the legal sector will follow. It is likely to become much more bespoke if different lenders opt for different interest calculation on the basis of SOFR, and that drafting will have to follow what the particular SOFR rate and the way it's calculated does. The deadlines are also uncertain, so I think we have been given a bit of additional time, as it seems, because there is consultation to postpone the discontinuation of USD LIBOR until the 30th of June 2023 instead of the 31st of December of this year, but that remains to be confirmed. So definitely watch this space for developments in terms of LIBOR, USD LIBOR, but specifically in terms of the deadlines that will apply in relation to the discontinuation. Irrespective of the final discontinuation date and when that happens for LIBOR, it has been recommended that the reliance on the replacement screen rate should stop being the norm, and it has not been recommended on the US market since the 30th of September 2020, and it will not be recommended on the UK market from the 31st of March of this year. Day one RFR loans, of course, are very likely to be entered into before LIBOR is discontinued. So we are predicting that this is unlikely to now happen in 2021 because of the postponement that is being discussed. Although I think that some lenders may do so for sterling loans, because as we have seen, there is much more certainty and there is a paved way forward in that area. We are also expecting lenders to start inserting rate switch provisions in the loan agreements to comply with the recommendations, while being able to rely on LIBOR for as long as possible, thus trying to create some flexibility in terms of how they deal with all of this when we actually reach finally the substitution point. Next one, Kevin, please. So before I enter into the discussions with Christos and Will, who will of course give us their very valuable perspective from the lenders and owners side, I wanted to leave you with a few recommendations that I've put up there in the slides in terms of what we see as being the way forward. And these are things that we have experienced at Stephenson Harwood very recently. And particularly with one of the deals that we documented late last year, where we actually inserted provisions that had to do with the substitution of USD LIBOR, not on day one, but at a specific point of time in the future. So that is quite dramatic, but of course that can be one way where in which the substitution and abolition is being dealt with. But in terms of sort of more measures on the due diligence side, I think what we're starting to see, particularly on the lender side, and we'll come into and discuss that, is to try and have some clarity in terms of which regulatory recommendations are applying to your section in the bank and to what you're doing, because that may depend on different factors, such as the country of incorporation of the lender, which branch you're lending through, which currency is being used, obviously, and so on and so forth. Trying to engage internally in order to create a transition plan. We have been engaged with a lot of banks and a lot of discussions with banks in terms of them formulating the transition plans and deciding how to go forward, both in terms of due diligence, in terms of the loans, but also in terms of documenting the switch mechanisms and when to do that. And perhaps starting to look, or even developing a template version of the rate switch provisions that will work for the lender in question. Next slide, Kevin, please. Obvious one, but yeah, it has to happen sooner rather than later. Engage with counterparties, borrowers, other lenders in syndicated loans, and so on as early as you can. The obvious risk and issue being that different lenders will have various different approaches in terms of the rate switch provisions. And start thinking about what kinds of rate provisions will apply, when, how, and when they will switch. At the same time, there has to be a clear and close monitoring of market developments, because as we have seen, particularly in the USD LIBOR space, market developments are very rapid and do change things very quickly. So it is important to keep a close eye on these. In terms of the derivatives, it is important to keep a close eye and understand the nuances in terms of the interaction with the derivatives. In addition to the question marks that have to do with the loan documentation on the particular deal, you have to consider whether there are derivatives in place, what will happen with those derivatives, and if they are continuing to apply and you are intending them to go forward, what's going to happen to them and how you're going to address that. The ISDA documentation seems to be particularly developed in this area, but of course each of the banks and the borrowers will have to make a decision as to how to deal with that, including the accompanying documentation. And the last point there, and last but not least, obviously it is about thinking about using opportunities to make the relevant amendments in order to maximize efficiency, both in terms of time but also in terms of cost. Next one, Kevin. Thank you. I think what I'll do, quite a lot of these things, I think we're going to discuss with Christos and Will. So if we have a little bit of time, we can put the slides back on, or we will make them available afterwards. But I don't want to steal their thunder, because that goes into the detail of what they are going to discuss about what they're seeing in the market and what they're thinking in terms of what banks and borrowers, owners should be doing in terms of the switch provisions. So if we can skip that one, Kevin. I will leave the slides with one thought, and that has to do with the practical issue of how interest rates will be calculated. The total interest payable for an interest period will only be available towards the end of that interest period. Borrowers will need to prepare some forecasts. They will need to be on top of this, and they will obviously need to have sufficient funds to pay this. But at the same time, the bank will need to monitor this very closely. We'll need to have sufficient teams and adequate teams to be doing that internally, and to be having that dialogue with the borrowers in order to make sure that the calculations are done at the right time and are communicated to the borrowers in the right way. And next one, Kevin. And that is it from me. I think I will leave it to that. There are a few points that I have left out, but as I said, I would like to open the panel up now so that Christos and Will can join. And a lot of these points, particularly on the practical sides, I was hoping that we could discuss all together, particularly since they are seeing the everyday reality of this. So Will and Christos, welcome, and thank you for joining me. I'm joined by Will Barrand, who is a director in the Maritime Finance Department of SMBC Europe, and by Christos Begleris, who is the co-CFO of Starball Carriers. So thank you again.
Hi, everybody.
Thank you for having us, Dora, and thank you to Marine Mani for giving us the opportunity to be here.
Thanks a lot. So I was going to start with Will. Will, I know we have discussed, and I know very well that you have spent a lot of time internally and beyond in terms of looking at the switch rates and the switch provisions, particularly in the USD LIBOR sphere. And I was going to ask you, where do you see what is the current status quo, and how do you see this moving forwards? Where do you see us going? What are the current challenges and the future challenges for the lenders?
Sure, thanks, Dora, and hi everybody. Thanks for having me on the call. You're absolutely right. I think, within the maritime space, discussions around risk-free rates and replacement to LIBOR probably haven't been too advanced. But, I think in the background, the banks have been working on this for a considerably long time with the regulators. And I think what we're also seeing is probably quite a lot more progress in certain currencies. So certainly on the sterling side, where we have a slightly more firm backstop deadline there. Now, obviously, maritime market is generally a US dollar denominated market. So the timelines for the majority of the transactions, I would have thought the banks and borrowers on this call will be engaged in, will really follow and track the US position. But in terms of what we can learn, I think quite a lot of other business units, quite a lot of other industry sectors, particularly the large corporates, probably some in the project finance infrastructure space that are borrowing in sterling, will already have well investigated now quite far down the line in terms of signing, if not day one RFR deals, then certainly, as Dora mentioned, transactions with pre-agreed conversion terms, which we refer to as benchmark switch agreements, where the loans will start out in LIBOR, but after a certain period of time, will switch to US dollar or switch to sterling, certainly for the sterling borrowers. So I think from a lender's perspective, what you would expect to see certainly between lending groups and also in terms of information from lenders to borrowers is increased communication, increased dialogue, and really guidance notes and advice on how LIBOR discontinuation has been progressing. I think sharing that information up front will get everybody familiar with the terms. I mean, there are a lot of terms and methodologies that I think if we went into a lot of detail, it'd be 300 to 400 people logging off to make a cup of tea. So we won't do that, but there are a lot of technicalities. I think the banks will already be very familiar with those in terms of how they're future-proofing their systems and future-proofing their documentation. I think in terms of the transactions, just one point that we should probably make at the moment is that, as Dora mentioned, we don't have any day one RFR transactions. What we have, considering using LMA wording, are the pre-agreed conversion terms where we start in dollar and then switch, start in dollar LIBOR and then switch to SOFR. But generally what I think the market is seeing is more the fallback position, which is really an agreement to negotiate, which is really pushing back the discussion between banks and borrowers until later in 2021, until the market has settled. Now, clearly the timelines may be a little more flexible, certainly in terms of how we approach transactions. And I think for most banks and borrowers, certainly the most in-scope transactions now will be the new transactions we're executing today, but we can't also forget the legacy portfolios or back books, i.e. any US LIBOR referencing loans that mature after the discontinuation date. They will also need to be amended. So there is a huge amount of work to do. There hasn't, I think, to this date, been a lot of dialogue within the market, but I think what borrowers should expect is a lot more outreach from their lenders to bring them up to speed with what the banks are doing and how they see the market evolving.
Thanks, Will. That's very useful. I think your point about the dialogue is very pertinent because everybody knows what they're working towards one way or another. Whether the deadline is this year, next year, or the year after. But I think particularly with the slightly differentiated approaches in the USD LIBOR sector, I think that has brought a little bit more uncertainty, which perhaps has scared people off in terms of starting that dialogue, at least before they sort out internally their systems and at least the methodology that they want to follow. Christos, are the banks reaching out to you? What are you seeing from your end of things?
Well, from our end, as Will previously mentioned, we have seen the replacement of screen rate clause being inserted in the new security documentation for the last 3 to 6 months, maybe. And it's interesting, it's not only on the loan facility documents that we see the replacement benchmark clauses, but we're now starting also to see this in, for example, ISDA documentation. At Starbuck, we have hedged quite a bit of our base rate exposure for the remaining 4 to 5 years. So actually, the replacement clause in ISDA documentation is really also important for us. There have been cases, for example, where we have reached out to banks to make more specific provisions about the replacement clause, and there was a pushback from the banks in terms of them not having crystallized where they want to be. And I guess that's also a result of the switch being pushed down by 2 or 3 years. And therefore, what we have in all our new facilities is basically the benchmark replacement clause, which effectively gives a negotiation period for both the bank as well as the borrower in order to determine all parameters with respect to the new benchmark rate that will replace LIBOR. And effectively what is being done now is non-contentious, right? There's not much to negotiate. It is to agree the parameters to negotiate in the future. So this is what we're seeing from our side.
Sure, I think that is exactly, you know, the sort of, I wouldn't say average, but I think that is the that is a fair description of where the majority of the players in the industry are at the moment in terms of documentation. And I think what you mentioned there in terms of derivative products is very important, because I think that was kind of put to one side for a long period of time. But once we get into the nitty-gritty of documents and into the nitty-gritty of agreeing the mechanisms as well, it is very important not to leave the derivatives behind, because they have to tie into each other effectively in order to push this forward. William, about the mechanisms, I'm not going to ask for methodology you guys are going to implement or anything like that, but what do you think are the challenges in terms of implementing any kind of methodology that is decided upon? And I don't mean just relationship wise in terms of the borrowers, but also in terms of like the systemic approach that the bank has to follow internally in order to implement that.
Sure. I mean, I think we've got to remember that, you know, risk-free rates in many of their forms have been quoted for many years now. So, you know, Bloomberg has the full list of the overnight, the risk-free rates, and also credit adjustment spreads, which, you know, will become common parlance as we move into the RFR regime. So I think a lot of the terms and the methodologies, whilst the exact calculations are maybe moving around a little bit, the underlying metrics are there and available. Clearly, the banks beneath the surface will be working at updating their systems, ensuring that all the loan booking systems are able to reference these rates. So, you know, if we'd followed the original timescales we all thought would be the case, certainly on dollar, 2021, you know, if 2020 was the year of IMO 2020, 2021 would have been the year of LIBOR switchover for the entire market. But I think now we're seeing a more graduated approach to that. That will give a little bit more flexibility, I think. And obviously the consultation is not yet closed. I think the result is expected around the 5th of February. So we are still talking hypothetical here, but I think there's a general expectation that there will be some more flexibility on the US dollar side. And I think that will give us a lot more time as both lenders and borrowers together to work their way through this process and become a lot more familiar with how we really will embed this operationally and day to day.
Sure, thanks, Will. That's very useful. I mean, yes, I was reading something that was sent internally the other day, and it was the chairman comments during the meeting that they were having most recently about postponing and pushing back the deadline. And it's not, it doesn't seem that everybody is in agreement within the committee either. So I think it is very much watch this space rather than it's set in stone. But so many other things are happening, and the 2021 deadlines would be fast approaching, and there wouldn't seem to be much that has happened this year. So I'm expecting we will have to go to 2023 by default. Kevin, are there any questions that you want to ask, or otherwise I'll ask Christos one more?
There's just one question that came in. I suspect a lot of people listening in are not terribly familiar with what comes next. And the question is, LIBOR has pretty much been an industry standard and universal concept. Is what's going to come next also going to make an sort of universal concept, or may there be variations depending on the institutions involved in things like this? Will, perhaps?
I think the current consensus is that yes, certainly for US dollar, SOFR, and the concept of a risk-free rate is definitely the norm for the moment. There are discussions about a SOFR term rate, which will effectively clone LIBOR and give you that fixed number right at the start of your interest period, rather than the slightly more complicated calculation that we're going to have to make, which really will be a compounded calculation looking back over the period of the interest with a lag of 5 days, as Dora referenced. Operationally, that will change things for all borrowers in the space. But I think this is the here and now. This is what's in front of us. We're certainly seeing it on the sterling side. We're seeing it with large corporates who have signed benchmark switch transactions, and there's a number that are very well publicized in the market in the UK corporate space. So there's certainly a lot of information to avail yourself of if you are looking and if you're intellectually curious. But I think the banks are doing what they can and should be doing what they can to help educate and help the borrowers along in terms of the transition.
Okay, thank you. Unfortunately, we're out of time. I mean, I think, Dora, what I should suggest is maybe 6 months from now, we do another of these webinars. We get together again, see where we are at that time. There may be a little bit more clarity in the market. But for the meantime, Dora, William, and Christos, thank you very much for joining us. Thank you.
Thank you.
Thank you.
Thanks, Kevin.